My name is Drake Bloebaum, Neo Home Loans. I'm a mortgage lender and have been for almost 20 years. Slightly after I got into mortgage lending, I started investing in real estate and have been doing that for almost 20 years now. Live in Salt Lake, but I own properties in Utah, Idaho, Kentucky, Pennsylvania, and just really feel passionately about investing in real estate because I believe in my heart of hearts that it's going to be challenging for people of this generation and the next generation to build a secure retirement without using some sort of real estate to do that. And, you know, I wanted to be retired yesterday. And so, you know, I'm a big skier, mountain biker, river rafter. So I want to be doing those things with my kids, my three boys. And the passive income from real estate is the most efficient, simplest way that I could think of to do that. And so my co-host today is Keon Tarimi. He's a realtor, investor, and lender. And Keon, not lender, I'm sorry, realtor and investor and web developer. And I'll let you introduce yourself as well.
Yeah, hi everyone. I'm Keon Tarimi. I actually have a background in the world of bioengineering and neuroscience. I've worked in a whole different industry. It was very cool, but at some point I got burnt out, and I did not want to make somebody else rich by working super hard. So I just quit. I quit my job, and real estate investing was a thing that was really dear to me, and is the reason why for the past 2 years I haven't had a job, and life goes on. My real estate investments are paying all the bills. So technically I am retired, but I'm not planning on just sitting still. So I started working on a platform that makes real estate investing easy for investors and also realtors. I was really frustrated with the fact that it was just so hard to get into real estate if you're not savvy and if you're not well connected. So I was on a mission to change that, and I would love to share that platform with you today and work on the how to do it. So Drake is going to present on why investing in real estate is very important, and I'll focus on how to actually invest and get started.
Perfect. All right, well, let's get into it. Okay, so our title of our show is Analyzing Property with AI and Building a Secure Retirement and Making Work Optional. I think a lot of times, you know, realtors talk about the power of real estate to build wealth, but I think they get stuck in a mindset of they don't want to. They get a little nervous in terms of helping people understand in the investing side of it, and they don't want to feel pushy and like they could potentially drive people into not so great of an investment. So our goal today is to help you get a little more confidence in talking to them about how real estate can build that upside for them in the long term, and then how to help them and feel more confident in educating them on which actual properties are good investments, right? You just don't buy anything and it will go up, which generally it does, but you can be a lot more targeted and specific with that. And I want you to come away from this with some excitement and optimism, because us as real estate professionals, realtors, lenders, we can really change people's lives, right? It's not just getting them into their home, doing a transaction and being done. We can have a meaningful impact on their retirement and help them make work optional sooner. And that's part of what I really enjoy about lending. So yeah, let's get into it. So the backdrop for this, in my mind, is inflation, right? And so what this chart shows is that the pace of new debt, total outstanding debt, trillions of dollars. So you can see that we hummed along at a pretty low level of debt all the way until about the 1970s. Of course, that's when we went off the gold standard. And since then, we've been able to create the Federal Reserve and the Treasury have been able to create money by just pressing a button. And you can see how that's gone since 1970. So what does this mean? All this new debt creates inflation. And the Federal Reserve's mandate is 2% inflation. Obviously, we've been living through a time in the last couple of years where we got as high as 8 and 9% inflation. So what is that? Why does that matter for us? It matters because real estate's one of the best investments that you can make to help with inflation. And this chart, this hockey sticking chart, right? Inflation's not going to slow down anytime soon. So like I said, their mandate is 2%, but we could be entering an era where they're going to have to let it run a little hotter than that because of the amount of new debt that the government has printed. So why are they doing this? Well, why are they issuing all this new debt? Why is inflation going higher? Because they've issued all this new debt. This benefits printing of money benefits the government because they can then pay back their debt, our debt, with dollars that are cheaper over time. And I have a quick little video to help you guys understand how that you can play the same game as a government. This is a pretty nerdy video, but I'm hoping that it lands and helps you guys understand why this is so important for real estate investors.
And unexpected inflation can hurt a consumer pocketbook. The reason is very simple, because those money you put in checking or saving account going to buy less goods and service because of inflation. On the other hand, for some households, especially for household who has a debt, the inflation could have upside. This is because the inflation not only reduce the value of your asset, but also reduce the value of your liability. So basically, you can repay your debt with depreciated dollar. It's also important to recognize that even the same household, they could have an asset and liability position. For example, a household could have a saving or checking account in the bank. So essentially, they are lending to the bank. And this asset position is going to get hurt if inflation is high. Exactly the same consumer or household, they could have a liability position. For example, they can borrow from the bank in form of mortgage. And the value of mortgage going to reduce because of inflation. So the net benefit or cost of the specific household depending on its liability and asset position. But this is very important to understand this underlying mechanism, of which is essentially a wealth transfer between lender and the borrower.
Okay, so let's park on that. A wealth transfer between the lender and the borrower, and inflation makes your debt smaller. So right, you're borrowing at a fixed rate of return, or a fixed interest rate, and you're paying it back with dollars that are worth less over time. So what I want you to just come away with is inflation benefits borrowers, right? We expect to have, there's always going to be inflation, which is good. Some low levels of inflation is good. But if you're playing the same game as the government is playing, which you are by borrowing on a fixed rate debt, you are using what the government's doing as a tailwind for your investments. Okay.
Yeah, Drake, sorry to interrupt. I wanted to add something. As a part of in the initial stages of building the company, I did a survey, and I wanted to see how people invest their money. Do they put it in real estate? Do they put it in the stock market, or so on? I was shocked to see that a significant portion of the people that I talked to just put their money in the savings account, and don't even invest at all. That was not what I had expected. So very surprising.
Yeah, and I mean, right, that's the worst place you could put it.
Yeah.
Even right now, there's some money markets out there that are 5%, which is great. But by the time you account for 3% inflation, now you're only earning 2%, and then you also have to pay taxes on that money. So you might only be earning 1% or so after inflation. So that's why real estate is such a powerful thing, because you're using inflation to your advantage, which is always going to be there in the background. Okay, cool. So yeah, and we're also, I would argue, in a little bit of in a new paradigm, right? Our parents and grandparents, the strategy historically was go to college, get a degree, get a job as an employee, avoid debt, save money, and you'll have a pension and Social Security to help you out with retirement. My argument is there's got to be a little bit of a new way. I think you have to be a little bit of an entrepreneur now. You have to have financial literacy. You have to use a little bit of leverage, and you have to invest to beat inflation if you want to have a comfortable retirement. So speaking of retirement, this is how the 4% rule is how financial advisors calculate how much you need for for retirement, also known as 25%, 25 times earnings. So in other words, this chart shows if you have $1 million in retirement, the first year of your retirement, you can take $40,000 out, and you can slightly adjust that up for inflation over a 30-year retirement period, and you should not run out of money, right? So let that sink in for just a second. You've saved $1 million a year, or you've saved $1 million for your retirement. Now you hit your retirement age, and if you want to have a 30-year retirement, you can take $40,000 a year, or about $3,300 a month out to live on. That doesn't sound that exciting to me personally. I used to think $1 million was a lot of money for retirement. But, I think we're realizing in this day and age that people are having to work a little bit longer and maybe don't want to be 100% retired and have some side income or whatever. But the point is, a lot of money, or what used to be a lot of money in $1 million, gets you surprisingly not that far in retirement when you're drawing off those assets. So this is from Charles Schwab. Basically what this shows is the planning time horizon. So let's say you have on the left column a 30-year retirement with a moderate asset allocation. They're saying you can take between 3.4 and 4.1% a year of your retirement assets and have a 75 to 90% confidence that you're not going to run out of money. If you have a shorter period of time, 20 years, you can take a higher percentage, 4.9 to 5.4%. And if you have an even shorter percent of time in retirement, 10 years, you can take closer to 9, 10%. Okay. But for me, and I think for a lot of other people, like I said, I want to be doing things. I want to be work optional as soon as I can. But for a 30-year retirement, to have a 1 in 4 chance potentially of running out of money after I've worked my whole life to save that just doesn't personally sit that well with me. So that's why I started looking for other ways. So here's what this looks like in practicality. So the top section there is a lifestyle today. So let's say your lifestyle today is $5,000 a month to live comfortably. If you wanted to have enough income or assets to retire and have $5,000 a month, you'd need $1.5 million in savings. That sounds like a lot of money. However, in 30 years, assuming 2.5% inflation, you're going to need $10,487 a month, staying in that first column, to buy the same amount of stuff that $5,000 a month buys today. So what that means is you really need over $3.1 million at that time to have the same lifestyle that $5,000 a month earns today. Okay, and you can see how these numbers play out as they get larger and move to the right. So how do we get there, right? So what a lot of people do, what most people do, they use their tax advantage accounts, their IRAs, their 401ks. You can use brokerage accounts, HSAs, all these things. There are great tools out there to do this, of course. And you invest in the stock market. Use some mixture of stocks and bonds, right? The average return of the S&P 500 is around 10.7% since 1957. And the goal is build this big nest egg, invest, let it grow until you have enough to retire, and then start drawing down off that money and in retirement, and hope that you die before your money runs out. But the challenge is that it's not the model that our country has been working off of isn't really working that good. As you can see here in this study by Vanguard, folks in retirement age 65 plus, the median amount they have in their retirement balance accounts is $87,000. The average is $280,000. Right? That's nowhere near those numbers that we were looking at in the 4% rule if you want $5,000 a month in retirement, right? So it's not working. People aren't getting there. So that's why I'm arguing that we need to have another way or an additional way, if nothing else. So, of course, there's going to be, hopefully, by the time we all get there, Social Security. So let's do a little case study based on a $5,000 a month income, right? So let's say we want to have $5,000 a month in today's dollars, and assuming 2.5% inflation, that tells us we're going to need about $10,000 a month in 2052. Okay, so you can go online and play with this yourself. A current earning of $60,000 a year. We want to figure out what our future inflated dollars are going to be at retirement and how much we're going to get in Social Security. So in other words, someone born in 1987 making $60,000 retiring in 2052 can estimate that they're going to get $5,200 a month from Social Security. So that's cool. That's half your $10,487. Follow me so far? So that's part of your retirement picture. That's great. The next piece is you've got to save the rest of that, right? So if you need to get to, call it another $5,200 a month, your other half of your $10,487, you need to have saved $1.57 million. Okay. So backing into that, if you earn an 8% return, you have 30 years to save and you start with $1. That means you need to be saving almost $1,200 a month. Okay. Let's think through that, right? This person right now today is making $5,000 a month. They pay taxes. They probably bring home $3,000 a month. And we're telling them that they need to save a little over around 30% of their income in order to have a comfortable retirement. That sounds tough to me. And I don't personally, in my practice, see that many borrowers that are saving that much money towards their retirement. So as I see it, there's two paths, right? You can invest in stocks, bonds, mutual funds, and build a portfolio of assets until you retire, at which time you start drawing those down and hope that you die before your money runs out, right? Because that's really what you're doing. The other path is you purchase a few homes that generate cash flow over time and allow the cash flow to fund your retirement. It's like a renewable resource, right? You're not drawing down the principal. You're letting the asset generate cash flow that continues as long as you manage it properly, right? And don't get me wrong, I am not saying don't invest in stocks, bonds, mutual funds. Do that. But what I'd like to open your minds and help you open your consumers' minds to is that if you can just buy one or two investment properties or buy your first property and move and keep that original property, you do that a couple of times, it can be an absolute game changer for your retirement. And us as real estate professionals are in a position to evangelize and help people understand that because frankly, they're not getting the type of financial education that they need. And I would love for more realtors and lenders to see themselves as educators that can help people understand this and change people's lives. So let's do a quick case study. We're going to talk about the 5 ways you get paid in real estate, which is great. Number 1, appreciation, right? We know this as real estate professionals. The value of your property goes up over time. Think about this. It's not really that your house gets more expensive over time. It's that your house is denominated in dollars and dollars are worth less over time. So your house becomes more valuable in dollars, right? So it's not so much that your house went up, it's that the dollar went down and it costs more of those dollars to buy your house. Amortization. Amortization is paying off your loan. Every time you make a payment on your mortgage, you're paying a little bit of your loan off. That's especially exciting when you have a property that is being paid by the tenant and the tenant is paying that loan off for you. Cash flow is the difference between your rental income and your expenses. Keon's going to go into more depth about that. Depreciation is a gift from the IRS that allows you to write off cost of the property as if it's losing value every year, even though it's gaining in value. So that can be its own separate class, but it can be a very powerful thing and something that generally that stocks don't offer, that can be another massive game changer and move the needle for your wealth over time. And then rent inflation. A lot of people don't think through that, rent goes up over time. When I bought my first fourplex, rents were $3,000 a month. Now they're almost $7,000 a month. So in 18 years, rents have more than doubled over that time. And I think as real estate people, investors, we should all have the rule of 72 memorized. And what that means, if you've never heard of it before, is you take whatever your rate of return is. So let's say 4%, and you divide that number, 72 by that number. That gives you your estimated doubling time. So the historical rate of return nationally over a long period of time for real estate is 4%. By the rule of 72, we divide 72 by 4. That tells us that our real estate historically, conservatively, is going to double in value about every 18 years. Cool. So let's take a look. So quickly, let's say you bought a $600,000 home today. At 4% annual growth in 20 years, that home's going to be worth conservatively $1.3+ million. Okay, so that's your appreciation. Amortization. Let's say you put 20% down on that home. In year 1, you have a $480,000 loan balance. In year 20, the renter has paid that down to $251,000. Okay. Rental income. Let's say on day 1, when you buy that property, it brings in $2,800 a month. With 4% annual increase in year 20, you're going to have $6,100 a month in gross rental income. Okay, so let's look at this overall. So my argument is like buying one house or keeping your house and turning it into a rental property, doing that one time can be like adding $1 million to your retirement portfolio. Why? Because first of all, you'll have that much equity, right? The difference between the value and the loan balance in 20 years is over $1 million. But more importantly, you'll have gross rental income of $6,100 a month. If the mortgage payment at the time you bought it was $2,700, you're going to have $3,400 a month in cash flow. Okay, so $3,400 a month times 12 is about $40,000, which is the same as you would be able to draw off $1 million stock portfolio. Except you don't have to worry about it running out. It renews and continues to grow over time as long as you manage that. The other thing that you can think about that's really cool about real estate is loans aren't taxed. So someone with this property, and this is part of what my strategy is someone with this property could take a cash out refinance at year 20 and get $734,000 in cash in their pocket based on 75% loan to value. That $734,000 cash is a loan, and loans are not taxed. So that's tax-free $734,000 that I can spend on whatever I want. And my new payment at that time, and of course we're estimating interest rates and whatnot, but $5,500, call it $5,600 a month, you still have almost over $500 a month in cash flow. So if when I die, pass that property over to my kids, they inherit a property with 25% equity. The cash flows a little bit and it starts over. Tenants pay down the loan, it continues to appreciate, and they can take money out again, a big chunk in 20 years. Or if they decide to sell it at that time, that's fine too. They can do so without capital gains because of the stepped up basis. So that's my argument of why you need to have real estate in your portfolio. So we'll let Keon take over. And any comments on any of that, Keon, before we do?
No, this was great. Thank you so much. And you can go ahead and make me a host so I can share my screen.
Right.
So hopefully by now you are convinced, and I'm assuming that you joined this webinar because you know how great real estate is as a vehicle to build passive income and wealth. So I'm not going to spend a lot of time on my slides because I want to jump into the platform, but just in case somebody is new and they may need to wrap their head around it, I'm going to talk about the two main ways that you can make money. One is, as Drake mentioned multiple times, is cash flow, which honestly I call icing on the cake, because the long-term gain of real estate is what builds wealth, and the cash flow is what makes the wheels go round and round every month. That is the case for me in right now, actually. So as you get rental income from a tenant, you budget for vacancy. That's the time of the time that you're expecting not to have a tenant in your rental property. And then gross operating income is the rent minus the vacancy that you budget for. And then we have operating expenses. Operating expenses could include the taxes that you pay annually, the insurance that you pay for anything that breaks down, if somebody has to come and fix the garbage disposal, all of that is the money that you budget. So when something comes up, when you need to replace the water heater, then you have the money you can just pay for. You don't have to think about, oh, do I have the money or not? So after that, we have net operating income. And then you have the mortgage payment. And once the mortgage payment is out, then what is left, which I call it money in your pocket, is cash flow. So cash flow is money in your pocket, right? This is how basically cash flow is calculated. And as Drake mentioned in his case studies, even if cash flow is only $230 in this case per month, which ends up being about $2,500 or so per year, as time goes by, as rents increase, and as your mortgage remains the same, cash flow amount keeps increasing. So when I bought my first property, it was cash flowing maybe $200. This is over like about 10 years ago. And now it's cash flowing the same property a good solid 2,000 a month, right? So, and it's only been about 10 years. And hopefully in the next 10 years, it's going to cash flow a lot more. The other way that you can make money is the long-term gain, or what really contributes to your wealth and to your net worth. And these are some of the factors that are related to how you can get this gain, like how much you buy a property versus how much it appraises for. So if a property appraises for 500,000, but you offer 400, you immediately, on paper at least, have instant equity of about 100K. Any type of improvement you make to a property, let's say you buy a fixer upper at 350, you make 50, you invest 50K in it to add value, to build it, to renovate it, and then you can sell it for 100. That's another added gain. As I mentioned, my friend Joe, who's here, he just bought a property for really good. He did his homework right. He added value and to it, and the property's worth a lot more. So he has instant equity in the property. Well, not instant, after a few months. Paying down your mortgage. Tenants make payments to you. You take that money and make the mortgage payment. Your balance on the mortgage goes down. That's great. The lower the interest rate is, the faster the more you can contribute to your mortgage pay down. But again, a lot of people are worried about interest rates being too high, and it's like, this is not a good time to invest, but it doesn't matter. If you can cash flow, it doesn't matter what the interest rate is, because if you don't put the money in your real estate, you don't have any money every month. But if you do it, even if the interest rate is high, you still have money coming in your pocket. And then later, when the interest rates go down, you can refinance. The other one is appreciation that Drake also mentioned. So as the value of the homes go higher, then you start making money. So this is a chart of equity over the 30 years. So you may have a little bit of equity in the property initially, but as time goes by, the equity goes high. So when you sell it or when you cash out, refinance it, you can get a big chunk of cash in your pocket. Or don't do it, just 1031 exchange it and defer the taxes. That's the other huge benefit of real estate, not paying taxes. So as a quick wrap up, long-term gain is where you can make the majority of your wealth in real estate, and that's the big factor. And cash flow is a smaller part, but it adds to your everyday monthly living expenses. So that's not expenses, income. So it's, in my opinion, there are two markets in the US, right? There's the cash flow markets like the Midwest, Southeast markets where properties are low, they're valued low. You can buy them easily and you can immediately cash flow even $100 for if you buy a property for 150,000. But in 10 years, that property instead of 150,000 may be now worth 180,000. So you really miss out on that long-term gain. Other states like California, Utah, there are the appreciation markets where you may not cash flow immediately, and it doesn't matter because over time you will cash flow and the house value will increase. So with all that said, I want to now switch to show you some of this on UBDO, which is the platform I've built to make real estate a lot more demystifying real estate for the investor. So um, one thing I wanted to mention is that UBDO is the way it's operates is that it's for each individuals. So when you sign up, it will ask you how much money do you have if you're an investor, and if you are a realtor, you can create these profiles for your clients. So how much money you have, what is your strategy, how much money you want to assign to repairs and maintenance, how much money you want to assign to vacancy, and so on and so forth. What is the interest rate that you are working with, that you have from your lender? Are you going to manage your own property or not? So here I have multiple different profiles. One of them, the savvy investor has $1 million, but they want to put only 25% down. Doesn't matter what the property is. Smart beginner investor has only 75,000, which is very respectable. They also want to do 25%. They are handy, so they put 3% towards repairs and maintenance because they're going to do a lot of the fixings themselves. As opposed to the savvy investor, they want to do the standard 5% towards repairs and maintenance and capital expenditures. And I have, let's say, the wealthy cash buyer, which has a lot of money. They want to put all cash down. They're not using leverage. So I'll show you how some of these come into play when we look at the properties.
Hey,
Now,
Keon,
yes.
question. Do you have auto-populated suggestions for these? So if somebody doesn't know, like, what should I use for repairs? What should I use for maintenance? Do you have suggestions for that?
Yes. So when you sign up, great question. When you sign up, it asks you two questions. How much money do you have available? And if you want to manage the property yourself, if you have an hands-on or a hands-off approach, and it will fill out everything else, but then it also explains what things are. So 5% will be by default, but then it kind of talks to you about maybe you want to increase it to 10%. Maybe you want to do less if you're going to repair things yourself. Yes.
Awesome. Thank you.
By the way, if you have any questions, please put them in chat and I would like to answer it. I want this to be more of a discussion rather than me just presenting to you. So this is a sample. So first, I'll show you some of these reports, some of these analysis that we get with UBDO and explain how to interpret it. And then I want to take some time and focus on how you can find these deals, which is the really exciting part for me. So initially or traditionally, investors have to deal with these complex Excel sheets, spend time filling it out. And after like half an hour, 45 minutes, you're like, well, it's not a good deal. Let's do another property. And then when you share that to your clients, if you're a professional, your client has to be savvy. If you're dealing with someone who's buying their first property, or they may not understand how to interpret some of these. So what UBDO does that it highlights what really matters, what's important. So at the very top, at the very top, by the way, the data is updated every 15 minutes and it gets pulled from the MLS. Right now, this is only available in Utah. But in the future, we're hoping to expand it nationwide. So you get all the basic information like the pictures of the property, year built, bedroom, bathrooms, description. If you're an agent, you can have access to the agent remarks. It rates the property using a proprietary algorithm. Based on the profile, it says how much money you have to invest. So here I have wealthy investor, but let's go back to the savvy investor, which is more of a typical 25% down type of investor. So This person will have to put $107,000 down. In 10 years, they'll have $12K in cash flow, this much in equity, and potential tax savings. And potential tax saving comes from how, with the right strategy, you don't either pay or pay very little on your monthly cash flow that you get from the property towards all these different strategies that allow you to not pay taxes. And also when you're 1031 exchange it into a bigger property. And we can cover that in a different webinar at a later time. These are the graphs that show how cash flow grows, how your equity grows. It gives you it calculates some of the performance metrics like IRR and cash on cash and cap rate. And if you're not familiar with any of this, you can just click on the question mark, brings up a very clear explanation. What is a summary of it? Example of how it's calculated, what it tells you and why it's important, and just more information about it. Everything is explained. And the other thing is that if somebody is not savvy, if you're working with a client and they don't really understand what an IRR is, it explains all of these numbers and metrics. Even though they're not a lot of them, it just highlights some of the top ones. It still explains all of that in plain English for them to just read and understand. For example, he says, impressive 10-year internal rate of return of 15.2 outperforms the stock market of ranging about 7 to 10%. So it puts all of this into perspective. Right below it, it gives some insights to help you make this a better deal. We know that every property can turn into a good deal with the right parameters, and UBD really helps you. So first of all, it analyzes the pictures of every deal and it tags it with a condition. So in this case, it tagged it at an looks like average condition, and it's suggesting that it will probably cost about 20 to 40K to update this property. And you can go and say renovation costs of $20,000. So that's one way that it helps you turn it into a better deal and make it more realistic. And then it recalculates everything on the fly. Then it says it does automatic comps. It does an automatic valuation for the property based on a very cool algorithm that also is proprietary, but says this property is estimated to have a value of 428, which is very close actually to what they listed it for. So it seems like it's priced right, but it says the price is slightly higher than what the value is. So maybe negotiate less. We say, what if we negotiate 420? And then it gives you other insights. So it pulls the rent estimates. This is what I showed you on my presentation, the rent estimate, the money after vacancy rate, all the expenses. It calculates everything for you. So with a single click, you get this beautiful report. And these come from our profile that we created. It estimates the insurance, it pulls the taxes from the MLS, any HOA dues, everything is just in one place. You don't have to go and manually enter all these numbers. And then here it says the cash flow is negative 135, right? And he also estimates the rent based on what's in the market. So you can click here and see some of the comparables that are available in this area. And you can see how in this particular case, the rent estimates are a little bit off to the side of where the property is. So it gives you a little bubble that says rent estimate may not be accurate because seems to be a little bit off. Just review it and make sure. And maybe you do your due diligence and you think it's only $2,800 per month. And now everything gets updated, including cash flow. And then it still tells you, hey, cash flow is negative. You gotta either see if you can rent more or have any other rental income opportunities or decrease the purchase price. And then what if we do 410, it's still negative, 400, it's now getting closer to a better deal. And if we scroll up, it's now a B plus. Let's say you get this property appraised and it comes out to be 450. Then now it becomes an A because you have that instant equity that you get between what you pay for it and what it's worth. So $50,000. And everything is really calculated into determining if it's a good deal or not. Let's look at another one. This is another property. It's a B plus right off the bat. It says it's also average in condition. So if we look at the pictures, you can see It's not bad. Maybe it needs a little bit of remodeling, some painting the cabinets. Again, walks you through it. What if we spend $10,000 in painting the cabinets and updating it? And then he comes up with the value of it to be about 309. So he tells you that it's the purchase price is higher than the estimated value, and also it's been on the market for 39 days. So you may be in a good position to negotiate a better price. What if we were to offer 290? And even though it was cash flowing at $70, I don't know if you saw it, but now it's 335. So very quickly, you have a deal that's now A plus, it will cash flow, and it could be a great investment opportunity for you or your client. So you can now go to the seller and say, hey, will you take 290, assuming that the rent is also is reasonable as well, right? Or looking at this one, this actually just popped up on the market in Mill Creek. Looks like a great opportunity. It's a B plus, but let's go down. So the estimated value is 323. It's listed at 320, so maybe seems right. It says that rent. It's interesting that two of these have the rents may not be accurate inside. Again, it's very sensitive. It really detects how relevant some of these rent estimates are. I mean, 20. I think 2,500 is reasonable. Some of these are. So let's say we do 2,450 for the rents, and it's basically cash flowing. It's no, you're not losing much. $23 is not that much money. So this is basically how this lets you do it. And if you're a professional, once you set this up the way you think it makes sense, like as per the purchase price, let's actually do $10,000 less. And now cash flow is positive. Once you set up the purchase price, once you review that the rent is correct and you find a deal, now you want to communicate it to your tenant, to your client, you can either email this to them and they'll get it as you set it up, or you can copy a link and send it to them. And I wanted to show you how this will appear from their perspective. I'm not logged in right now. I'm in incognito mode. And because you're a professional, your name and information, your brokerage, all the information shows up on top left, and they are able to see the property exactly as you set it up for them, with the rating, all the important highlights as well. So now that I showed you how this report looks and how you can work out a deal and make it better so quickly, I want to show you how you can actually find properties. So go into the website, clicking on find properties. So the real cool power of this platform comes with how the way you can search for properties. Just like Zillow or your local MLS's website, you can do searches by some of the basic searches, like up to $600,000 of price, let's say 2 bedroom, and let's not include twins and mobile homes. So very basic search. And by the way, by default, it shows the properties that are on the market based on how long they've been on the market. So green means recently listed, yellow means they've been on a while, and so on. Black means 120 days or more. You can see how there's so many properties that have been on the market for 130 days. So visually, you can see there is room for negotiation for some of these black or red opportunities. But then the cool thing comes from how you can search. So not just visualize it by days on market, but actually visualize it by gross yield or cap rate. And cap rate, if you remember, is rent income minus expenses divided by the purchase of the property. It's a great ratio to look at. So there, right on the map, it identifies properties that have, oh, actually, this is one of the ones that we're looking at earlier. Properties that have good potentials to be great investment properties. But, what if we just care about cash flow? We want to buy a property that cash flows for us. So let's go back to Deal Finder, click on cash flow, and then set some sort of a limit. We don't want to see anything that's, let's say, less than negative $500 of cash flow. And what this does is that it mass analyzes every property on the market as if you were putting every property in your Excel sheet and shows you how much each property can cash flow right on the map. So when it says $76 for this property, it means that if you buy this property, given your assumptions, how much money you told it that you have, how much money you want to put towards repairs and maintenance, you will have $76 of cash flow in this property. If you buy this one, you will lose $430. But then remember, it walks you through making a better deal, either limit your losses or convert it into a positive cash flow. This is incredible. You can visually see which property can make you money and which ones will not make you money.
Yeah, and I
But
think one of the coolest features you showed me was how it does the computer analysis of the photos, and you can see the condition of the property. That would be somebody that's looking to walk into some equity or build some equity. I think that would be a really cool thing to show.
yeah, exactly. So the next, as Drake said, and I've never met you, Drake. I didn't ask you to ask this question before, right? But great segue. So you can actually search by property condition. This I've never seen anywhere else. You can say, I am looking for just turnkey properties that cash flow at least $0. So there may be none, but let's see. Oh, there's one here in West Valley. So this is a duplex and it's turnkey. So how it knows is that it uses computer vision to analyze all the pictures of each property and then it tags it. Let's say you're looking for fixer uppers that have been on the market for at least 60 days. So let's go and change the days on market to at least 60 days, and we change the condition to needs renovation. So there you go. Fixer uppers that have been on the market for 60 days. How quickly we can find properties that have potential for value add. So spend some money in it, make it better. Or you can even do distressed if you are into distressed properties. Let's go look at some distressed properties. So these are properties that are in really, really bad shape. Let's actually look at this one. I mean, look, the window is boarded out. I mean, it's a really cool feature. So let's remove the filter for days on market and now search. There's a ton more. This one has been recently listed a few days ago. It's in pretty bad shape. Look at this. So the in the end, I just want to make it very clear that with this platform, you can find properties that either are fix and flip opportunities or they cash flow. And if you're an agent, because these reports are so clean and so clear and they don't intimidate your clients, you can send these beautiful reports to your clients and help them understand how much they can gain in over time. So highlights of in 10 years, you can have $1,800 in a year in your pocket. That's $1,500 with only, I say only, $80,000 of initial contribution. So if your tenant puts down $80,000, this by the way includes closing costs. In 10 years, they can have $18,000 of cash in their pocket. This is after all expenses, after any kind of money that they have to spend towards the property. And they'll have their $80,000 becomes $360,000 in equity in the property and potential tax savings. You know, I love the stock market. I have probably my investment is about half stock market, half real estate. But the thing that really bugs me about the stock market is that the moment you pull money out, you pay 15 to 20% of in taxes if it's long term. If it's short term, then forget about it. It's by your income tax bracket. Real estate, you basically, if you have a good tax person, you can do next to nothing or potentially zero. Because you're a real estate professional, you can actually use the tax savings of that you get through real estate and write it against your actual income that you get. And again, please talk to a tax advisor. I'm not a tax professional, but there's so many different ways that real estate has great tax benefits. Now, I just wanted to open it up to any questions. If you have any questions, I would love to help answer it.
How do people go play around with this, Keon? Can they
It's
just go to the site and
just go to ubdo.com and you can create a free account. So everything is free except for these advanced search features. But even that is free for a month. Just go in, sign up, and use it. If you're a realtor, we have a trial of 3 months. We really believe in adding value to realtors. We are so confident that this platform is going to change the way you do business. We want you to try it for 3 months. If for any reason you don't think that it was beneficial or you didn't like it, full refund, no questions asked. Again, we only want to add value to people, so please go check it out. Again, it's free. It's free for your clients if you send them. So you can set up automatic searches based on, let me show you. You can set up automatic searches based on different criteria. Like for this person, I am sending him properties that need renovations or distressed all over Utah. And every day he just gets an email, or maybe some days he won't get an email, depending on how tight his search is. Someone like Corey, he only gets an email every few days because he's really looking for American Fork and Lehigh, and he's looking for properties that give him the best return on his investment. And if you're working with real investment clients, it's not like when they're buying a home every day, you don't send them deals, and every day you don't go and look at homes. A lot of investors are opportunistic, so they may just only pull the trigger when the right deal comes to them. You can, as a realtor, you can't just go on the web and search and keep sending deals. You want to automate this and let it just run in the background. So this is an incredible feature. And then, so this is the type of email they get. They get an email that says, I found the property. They click on it. This is what they see. A summary of all the properties that match their criteria. They can click on it and see it. Again, free for them. They can just look at any of these properties. Yeah, so
it just seems so like you can save so much time when trying to find, that's where the deals, right? You make your money in real estate on the buy side. And so finding and searching for these deals is, if you pull up the main search, like there's thousands of properties listed for sale right now. How do you narrow that down to what are the good properties, right? And to
yeah,
be able to find properties that are distressed where you can walk into equity and add value through renovations. And then that also helps you improve your cash flow over time, right? It's just, I mean, it could just save you hours and hours and hours of analysis.
exactly. It's instead of looking through pictures and looking for this, properties that we need renovations for a particular client, you just set it on auto and it does the work for you, saves you hours of time. So yeah, if you have any questions, please feel free to ask right now. Okay.
Cool. We'll
Um,
wrap it up and we'll send this recording to everybody. And we will also send our contact information if you have any questions about real estate investing, uh, how to buy distressed properties, how to analyze, how to use the website. Our contact is here. We'll leave that up for a minute. You can screenshot those QR codes. Take you to appointments setting up for either one of us. And we're grateful that you came, and we hope that we've helped you understand and get a little bit more excited about real estate investments.
Thank you. Thanks, everyone. Great meeting you. Hope to see you soon. Take care. Bye.